EPK Capital presents Daily Brief, 23rd August 2025. Hello everyone, welcome to EPK Capital's Daily Brief video. I am your host Brandon. In this series we try and update you and make sense of all the important news from the world of finance that came out globally. So, without further ado, let's begin. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice. For your personal financial advice, kindly get in touch with us on details in description, or you can connect with your financial advisor. To understand the day's complex narrative, we must first look at the scoreboard. The global markets presented a fractured picture, with pronounced weakness in the United States, a mixed session in Europe, and a dramatic divergence across Asia, where Indian markets continued a powerful rally in defiance of the global trend. Region index closing level, point change, percentage change, Americas, Dow Jones Industrial Average 44,785.50, down by 152.81 or 0.34%, S&P 500 6,370.17, down by 25.61 or 0.40%, Nasdaq Composite 21,131, 7.255, 0.34%, Russell 2000, 274.10, 4.74, 0.20%, Europe, FTSE 100, UK 939.20, 2106, 0.23%, DAX, Germany 20,203.34, 6.37, 0.7%, Asia Pacific Nikkei 225, Japan 46.10.7, 288.38, 0.65%, Hang Seng, Hong Kong 25,104.61, 61.33, 0.24%, Shanghai Composite, China 3,771, 34.89, pro 13%, Sensex India 82,071, SOM 42.87, probably 70%, Nifty 50 India 25,083.75, so 3.20, probably 30%, 3. US markets in retreat, a fifth day of losses. Wall Street extended its losing streak as investor anxiety mounted ahead of tomorrow's key events. The broad S&P 500 fell approximately 0.4%, marking its fifth consecutive session in the red, though the daily losses have remained relatively contained. The index closed around the 6,370 level. The Dow Jones Industrial Average also retreated, shedding about 153 points, or 0.34%, to finish near 44,785. The technology sector, which has been the market's engine for much of the year, continued to show signs of fatigue. The Nasdaq Composite was an underperformer for the week, falling by about 0.3% to 0.7% on the day, to close near 21,100.3. This weakness was driven by a continued rotation out of high-flying, AI-related stocks, amid growing concerns about stretched valuations. The specialized NYSE FANG Plus index, which tracks mega-cap tech giants, underscored this trend with a sharp decline of 1.54%. However, a subtle but important divergence emerged beneath the surface. While large-cap indices fell, the Russell 2000 index of smaller companies was the only major US benchmark to finish in positive territory, posting a modest gain. This is a classic signal of a risk-off rotation. It suggests that investors are not fleeing the market entirely, but are shifting capital away from high-valuation growth stocks, which are more sensitive to interest rate fears, and into other areas of the market, such as value-oriented small-cap names. This is not random market noise, but a coherent theme of defensive repositioning. Confirming the rising unease, the CBOE Volatility Index, or VIX, often called the market's fear gauge, rose for a third straight day, signaling increasing demand for portfolio protection. A mixed picture in Europe. European markets painted a mixed but generally more resilient picture than their US counterparts. The UK's FTSE 100 index was a standout performer, gaining 0.23% to close at a new all-time high of 9,309, 20.5. Germany's DAX also managed a slight gain of 0.07%. However, this headline strength masked underlying weakness. A deeper look at individual European blue-chip stocks reveals a sea of red, with major companies like LVMH, SAP, and L'Oréal all closing down by more than 1%. The great divergence in Asia. The most compelling story of the global session was the stark divergence seen across Asia. While most of the region followed Wall Street's negative lead, India's markets continued their powerful bull run. In a remarkable display of resilience, India's benchmark indices extended their rally for a sixth consecutive session. The BSE Sensex climbed 143 points to close at 82,071, while the NSE Nifty 50 added 33 points to finish at 25,083.75. This strength is a clear example of a market decoupling from global trends. While foreign institutional investors have been net sellers, reflecting global jitters, strong and sustained buying from domestic institutional investors, fueled by optimism around domestic policy initiatives like a potential GST rate rationalization, has more than offset the outflows. This highlights a crucial theme for global investors. Strong local narratives can, at times, override global headwinds, creating a more complex, multipolar market environment. Elsewhere in Asia, the mood was far more subdued. Japan's Nikkei 225 fell 0.65%, and Hong Kong's Hang Seng Index dipped 0.24%. Mainland China's Shanghai Composite was a modest outlier, eking out a 0.3% gain. The macro pulse: good news is bad news. The primary driver behind the slump in US markets was a classic case of the good news is bad news paradox. A slate of surprisingly strong economic data was released, which, in a normal environment, would be cause for celebration. However, in the current market, where investors are laser-focused on the Federal Reserve, this strength was interpreted as a significant headwind. The US economy's surprising strength, the PMI report. The main catalyst for the day's negative sentiment arrived in the morning with the release of the S&P Global Flash PMI data for August. The manufacturing PMI registered a stunning 53.3, a more than three-year high and dramatically exceeding economists' consensus forecast of 49.5.9. Any reading above the 50-point threshold indicates expansion in the sector. The services PMI was also robust, coming in at 55.4, well into expansionary territory. Taken together, this data paints a picture of US business activity accelerating at its fastest pace this year, suggesting an economy that is not only resilient but potentially re-accelerating. The market's perverse reaction. The market's reaction was swift and negative. The core issue is that strong economic data fundamentally undermines the rationale for the Federal Reserve to cut interest rates. Wall Street has been operating under the assumption that a softening economy would compel the Fed to begin an easing cycle, with traders pricing in a very high probability of a rate cut at the upcoming September meeting. The robust PMI report directly challenges this narrative. The causal chain of the market's reaction was clear and direct. First, the strong data, which also noted that tariffs were helping to push up average selling prices at the fastest rate in 3 years, sparked fears of persistent inflation. Second, this combination of strong growth and inflation risk sent yields on US Treasury bonds sharply higher. The benchmark 10-year Treasury yield climbed to around 4.33%. Third, higher bond yields reduced the present value of future corporate earnings and increased borrowing costs, a dynamic that disproportionately harms the valuations of high-growth technology stocks. The result was a sell-off in the Nasdaq and S&P 500. A confusing consumer picture. Adding to the complexity, other data released during the day painted a more muddled picture of the US consumer and the broader economy. On the positive side, existing home sales for July came in better than expected at 401 million versus a 3.92 million consensus, adding another piece of evidence to the economic resilience theme. However, the preliminary University of Michigan Consumer Sentiment Index for August told a different story. The index fell for the first time in 4 months to 58.6, with consumers explicitly citing rising worries about inflation as the reason for their deteriorating outlook. In Europe, the flash consumer confidence indicator for the Eurozone also declined in August, remaining significantly below its long-term average. Meanwhile, Weekly jobless claims in the US rose modestly, a potential early sign of softness in the labor market. This collection of conflicting data points perfectly encapsulates the Federal Reserve's current dilemma. The strong PMI data signals accelerating business activity and rising price pressures, arguing against rate cuts. At the same time, weakening consumer sentiment and a potentially softening labor market suggest that a policy cut may be needed to support the economy. This creates a stagflationary risk, where the Fed is caught between its dual mandates of controlling inflation and maintaining maximum employment, making Chairman Powell's communication task tomorrow exceptionally difficult. The elephant in the room: Jackson Hole and the Fed under pressure. The day's market action cannot be understood without appreciating the immense significance of the Federal Reserve's annual Economic Policy Symposium, which began today in Jackson Hole, Wyoming. This event has become a critical platform for the Fed to signal major policy shifts, and this year the stakes are higher than ever, setting the stage for Powell's high-stakes speech. The theme for this year's symposium is Labor Markets in Transition: Demographics, Productivity, and Macroeconomic Policy. Federal Reserve Chair Jerome Powell is scheduled to deliver his final keynote address of his term on Friday at 10 a.m. Eastern Time. Investor expectations are pinned on Powell providing a clear signal that the central bank will resume cutting interest rates at its September meeting. However, a growing chorus of analysts is warning that he may disappoint the market. Given the strong PMI data and persistent inflation concerns, Powell is likely to maintain a cautious, data-dependent stance, reiterating that the Fed needs more time to evaluate the economic landscape, particularly the inflationary impact of tariffs. The political firestorm, an unprecedented challenge to Fed independence. Layered on top of this economic uncertainty is a political drama of historic proportions. President Donald Trump has dramatically intensified his public pressure campaign on the Federal Reserve, challenging the very foundation of its political independence. The most significant development occurred on Wednesday, when President Trump publicly called for the resignation of Federal Reserve Governor Lisa Cook, who was appointed by the previous administration. The call was based on unconfirmed allegations of mortgage fraud raised by the director of the Federal Housing Finance Agency, Bill Polt. Governor Cook swiftly rejected the demand, stating that she would not be bullied into resigning. This direct political attack on a sitting Fed governor, just days before the Jackson Hole speech, is a highly unusual event in American politics. It raises profound questions about the future of central bank independence, which has long been considered a cornerstone of the US financial system's stability and credibility. This political pressure makes Chairman Powell's communication task on Friday exponentially more difficult. If he hints at rate cuts, he risks being perceived as caving to political demands, which could damage the Fed's long-term credibility. If he maintains a hawkish tone in defiance of the pressure, he risks a severe market sell-off and further political attacks. His speech is no longer just an economic forecast. It is a tightrope walk to defend his institution's integrity. Additional political development: US-EU trade framework. In other political news, the United States and the European Union announced a framework for a major new trade agreement. The deal is aimed at reducing tariffs and non-tariff barriers across a wide range of goods, including the EU eliminating tariffs on US industrial goods and the US adjusting tariffs on European automobiles. While this represents a significant and positive long-term development for transatlantic trade, the news was largely overshadowed by the market's intense, near-term focus on the Federal Reserve. Movers and shakers, corporate and sector stories. The day's high-level macro and political themes had very real and tangible impacts on individual companies and entire market sectors. The behemoth stumbles. Walmart's earnings. Disappointment retail giant Walmart reported its second quarter earnings before the market opened, and the results provided a clear window into the market's current unforgiving psychology. On the surface, the report was quite strong. Revenue grew by nearly 5% year over year to $177.4 billion, beating analyst expectations. US comparable sales, a key metric of retail health, rose a robust 4.3% to 4.6%. Global e-commerce sales were a particular bright spot, surging 25%. The company even raised its sales and profit outlook for the full fiscal year. Despite these positives, the market focused on one negative data point. Adjusted earnings per share, EPS, of 0.68 came in just below the consensus estimate of 0.73. Operating income also fell by over 8%, though this was impacted by one-time legal and restructuring costs. The market's reaction was severe. Walmart's stock plunged by 4% to 5%, making it one of the heaviest weights on both the Dow Jones Industrial Average and the S&P 500. The stock's decline, despite a largely positive report, reveals a market with a very high bar for success. With the stock having already gained significantly year to date, expectations were so elevated that even a solid performance with a minor EPS miss was not good enough. This signifies a nervous market with little tolerance for any imperfection. A political casualty, the solar sector sell-off. A starker example of market-moving news came from a direct political statement that decimated an entire industry for the day. President Trump stated that his administration would not approve new wind or solar projects, citing concerns about high electricity costs in states that utilize renewables. The market reaction was immediate and brutal. The statement triggered a massive sell-off across the renewable energy sector. Shares of First Solar, FSLR, plunged 7%, leading all losers on the S&P 500. Other prominent solar stocks, including Sunrun, RUN, Enphase Energy, ENPH, and Solar Edge, CDG, also fell sharply. Canadian Solar, CSIQ, was hit particularly hard, dropping nearly 20% after it also issued a weaker-than-expected guidance for the third quarter. This event serves as a powerful reminder that in the current environment, policy risk driven by political rhetoric can be just as impactful to a portfolio as traditional economic or earnings risk. The digital frontier. Cryptocurrency market update. In the world of digital assets, the market was characterized by continued volatility and a major regulatory announcement that could have profound long-term implications. Bitcoin and Ethereum. Volatility and key levels. The cryptocurrency market has been attempting to find its footing after a sharp correction. Bitcoin, BTC, has been volatile, dipping below the $113,000 level before staging a modest recovery to trade in the $113,600 to $114,000 range. The leading cryptocurrency remains down nearly 8% over the past week, well off its recent all-time high of over $124,000. Ethereum, ETH, showed some relative strength during the session, rising over 3% at one point to reclaim the key $4,300 level. However, it gave back those gains to close the day down 2.7% at $4,239.59. Overall sentiment in the crypto space remains cautious, with the Crypto Fear and Greed Index recently bouncing from fear back to neutral territory. A new dawn for crypto? The regulatory tailwind. Perhaps the most significant long-term news of the day for any asset class came from a US regulator. The Commodity Futures Trading Commission, CFTC, announced that it is launching a new Crypto Sprint initiative. The stated goal of this initiative is to fast-track the implementation of recommendations from the President's Working Group on Digital Asset Markets. In the press release, Acting CFTC Chairman Caroline D. Pham was remarkably direct, stating the objective is to enable immediate trading of digital assets at the federal level. In a highly unusual move for a regulatory body, the announcement was explicitly political. Chairman Pham stated that the initiative answers President Trump's call to action for American leadership, and that the Trump administration has ushered in a new dawn for crypto. This development signals a potential 180-degree turn in the US regulatory posture, shifting from a period of ambiguity and enforcement actions to one that actively seeks to foster innovation and create clear pathways for onshore trading. A supportive federal framework for spot crypto trading could fundamentally de-risk the asset class and unlock significant institutional investment. Conclusion, synthesis, and outlook. So, what is the final takeaway from a day of conflicting signals? We have a US economy that refuses to roll over, creating a major headache for a Federal Reserve that the market desperately wants to turn dovish. This economic strength is clashing with an increasingly fragile investor sentiment, leading to a slow bleed in the major indices. Layered on top of this is a volatile political environment where the Fed's independence is being openly challenged, and presidential rhetoric can wipe out an entire sector's gains in a single afternoon. Meanwhile, in the digital asset space, a potentially revolutionary pro-crypto regulatory shift is quietly beginning. This all sets the stage for a monumental speech from Jerome Powell tomorrow. The market will be hanging on his every word, and the potential outcomes are binary and stark. A dovish pivot, where he acknowledges the softening labour market and downplays the strong PMI data, would signal that a September rate cut is firmly on the table. This could ignite a powerful relief rally in stocks and send bond yields lower. Conversely, a hawkish stand, where he focuses on sticky inflation, robust business activity, and the risks from tariffs, refusing to pre-commit to a rate cut, could see this 5-day slide accelerate significantly. The stakes could not be higher. Be sure to join us tomorrow as we break down the market's reaction in real time. And that's all we had for this video. We hope this video was informative for you. If you think it was, then please do like and share this video. Also, do not forget to subscribe to our channel for such wonderful daily content. You can also follow us on Instagram and Twitter. The details are in the description.